Welcome to the deep dive. Today we're getting into Bill Ackman and Pershing Square. And our research really pushes past that simple hedge fund manager label.
Right. It's much more about seeing him as running an investment holding company. The focus is really long-term ownership, concentrated bets.
Okay, so where does that philosophy start?
Well, the foundation, it really goes back to Benjamin Graham. The classic value investing principles.
Price is what you pay, value is what you get.
Exactly that. And also the market being a voting machine short-term, but a weighing machine long-term. Ackman marries that with a very proactive, sometimes, activist style.
He calls it temporal arbitrage, which sounds a bit academic.
It just means exploiting that gap, right, between the market's short-term mood swings and the actual long-term business value. He waits for the market to, well, mess up.
Interesting. But Graham focused a lot on tangible assets. One source mentioned Ackman's ideal targets are growth royalties. What's that about?
Yes. That phrase really captures it. He wants predictable quality. Businesses with capital-light models.
Meaning?
Meaning they collect royalties or fees without owning all the, heavy underlying assets. Think Hilton or Tim Hortons back in the day.
Okay, so they don't own every single hotel room or coffee shop.
Exactly. They just get a predictable stream from the transactions. Less capital stuck in physical stuff.
And the advantage there is?
High returns on invested capital. ROIC. That's the engine. It generates lots of cash, predictable cash, which can compound over time. That's what he's looking for.
Got it. Now, this current framework, it wasn't just thought up, was it?
Oh, no. Not at all. It was really forged in fire. Pershing Square runs famously concentrated maybe 8 to 12 main investments. That concentration, well, it led to some really tough years.
Right, around 2015 to 2018.
Yeah, a period of major underperformance, and that forced the firm to really codify its approach into what they call the 8 Commandments.
And the trigger for codifying those rules, that was the big one, wasn't it? Valiant Pharmaceuticals.
The huge loss, yes.
Mm-hmm.
About $3 billion. It became the textbook example of how conviction without strict rules can be, well, disastrous. Valiant broke so many of their own implied rules.
So what were the key violations there, according to the commandments that came later?
Well, number one, the business has to be simple and predictable. Valiant was anything but. It was a complex roll-up.
A roll-up.
Meaning its growth depended entirely on buying other companies fueled by debt, then cutting costs aggressively. It looked good on paper for a while, but it was inherently fragile, not simple, not predictable long-term.
And all that debt, that must have violated another rule.
Definitely. Commandment number 7 needs a strong balance sheet, one that doesn't need outside capital just to survive. Valiant was heavily leveraged, very weak balance sheet.
It's a complex business model, weak finances.
And it also violated the idea of avoiding situations where the worst case is a permanent loss of capital. With Valiant, when things went bad, they went really bad. No easy recovery.
It's wild that they literally had these rules engraved on stone tablets at the office.
Yeah, apparently so. To make sure those lessons, those very expensive lessons, were institutionalized, baked right into the firm's process.
So that discipline is what makes the high concentration strategy viable now.
That's the idea. Concentration forces incredibly deep research. You have to know those 8 to 12 companies inside out, and it ensures your best ideas actually move the needle for the fund.
But concentration still feels risky. What about big market downturns?
Right, which brings us to maybe the most famous tactical move.
Yeah.
The COVID hedge in early 2020.
Ah, the big asymmetric bet.
Exactly. They saw potential systemic risk building. So they spent, relatively speaking, a small amount, about $27 million on credit default swaps. Basically insurance against a corporate bond market crash.
A small bet with a potentially massive payout if things went south.
Precisely. It was protection. And when the market did crash in March 2020, that position paid off enormously.
How much?
They cashed out for around $2.6 billion. And that influx of cash was crucial. It didn't just cushion the blow to their existing holdings. It gave them dry powder, lots of it, allowed them to buy more of their high-conviction stocks when they were suddenly on sale during the panic.
So it was both defensive and offensive. Incredible timing.
It showed how risk management, even with a concentrated portfolio, could be tactical and opportunistic. It all ties back to that disciplined framework, learned the hard way.
So it's a story of evolving from pure conviction to a system built from analyzing failure. Which brings us to our final thought for you, the listener. Think about that one really tough lesson you've learned professionally, the one that maybe cost you dearly. What part of that learning are you willing to metaphorically engrave in stone to make sure you don't repeat that mistake? Something to think about.